When we talk about running a small business, most entrepreneurs immediately think about growth, sales, and serving customers, and those things matter. They matter a lot. But in my years of working with small business owners, I've seen far too many fall into the same trap. They focus so heavily on bringing money in that they neglect to protect the money they already have. They work hard, they sell more, they take on more clients, but when the year ends, their profit is far smaller than expected. And the reason is often simple: accounting mistakes. Not the kind of mistakes that make headlines or involve fraud, but the quiet, everyday financial missteps that chip away at earnings month after month, year after year. In 2025, these mistakes are even more dangerous because the environment for small businesses is more competitive than ever. Costs have gone up, labor expenses have risen in most industries, customers have higher expectations, the tax code has shifted in several areas, meaning certain deductions you used to rely on may have changed, and others you didn't know existed are now available. Add in the rapid adoption of AI-powered bookkeeping and tax software, which is helpful but not foolproof, and the margin for error gets smaller. Mistakes that you could recover from in a slower market might now be the difference between staying profitable and falling into debt. One of the most fundamental and surprisingly common issues I see is business owners mixing personal and business finances. Now, on the surface, it can feel harmless. You grab lunch with a client, you use your personal debit card, you make a supply purchase for the office and pay with your personal credit card. Or maybe a customer payment comes in and you deposit it directly into your personal account because it's faster. But this approach blurs the line between personal and business activity. It creates confusion when you try to track profitability. And importantly, it can jeopardize your legal protections if your business is structured as an LLC or corporation. In an audit, if the IRS or your country's tax authority sees commingled funds, they may disallow certain deductions entirely. Worse still, if you're ever involved in a legal dispute, failing to keep finances separate can allow a court to pierce the corporate veil, meaning your personal assets could be at risk. The fix is straightforward. From day one, open a business bank account and business credit card, and route all transactions exclusively through those. Not only will this make bookkeeping far easier, but it will also give you a crystal clear picture of how your business is performing. And in 2025, most banks offer online integrations that automatically sync with accounting software, saving you hours of manual work. Equally damaging is the tendency for owners to neglect regular bookkeeping. I've heard so many say, "I'll catch up on the books at the end of the month," or "I just do it at tax time." The problem is, when you only look at your numbers every few weeks or months, you miss important signals. A sudden jump in costs, a decline in margins, or a customer who's behind on payment can slip by unnoticed. According to a 2024 Intuit QuickBooks survey, 42% of small business owners admitted that they track their finances less than once a week. This lack of visibility can lead to poor decision-making. Imagine running a marketing campaign, thinking you have the cash to support it, only to find out later that a large supplier payment was due and you're short. The solution is to implement a routine. Even just 20 minutes twice a week spent reconciling accounts, reviewing expenses, and updating invoices can save thousands over the course of a year. And yes, AI-powered tools can help here, but remember, they rely on accurate data inputs, so human oversight remains essential. Another area that often flies under the radar is expense misclassification. On paper, it may sound minor. You accidentally label a new laptop as office supplies instead of equipment, or you categorize business travel under entertainment. But misclassification affects how expenses are treated for tax purposes. In the U.S., Section 179 allows for the immediate deduction of certain types of equipment, but only if they are categorized correctly. Misclassifying can delay or even eliminate that deduction, costing you money. And in 2025, tax authorities are using more sophisticated algorithms to flag unusual expense patterns for audit. I've seen businesses lose legitimate deductions simply because the expenses were placed in the wrong category. A quick review of your chart of accounts with an accountant can prevent this. And if you're using accounting software, most platforms allow you to lock in default categories for recurring transactions, reducing human error. Then there's the deceptively simple habit of not keeping receipts. Many small business owners assume that bank and credit card statements are enough proof of a purchase. Unfortunately, they're not. A bank statement shows that money left your account, but it doesn't show what was purchased or why. Tax authorities require detailed records. to substantiate deductions. Without them, even legitimate business expenses can be disallowed. And in 2025, with more audits being done remotely through digital submission of documents, missing receipts can slow down the process and raise unnecessary questions. The good news is, this is easier than ever to fix. Cloud-based apps like Expensify, HubDoc, and even built-in phone scanning features allow you to snap a photo of a receipt the moment you receive it and upload it directly into your accounting system. Over time, this habit becomes second nature, and it protects every deduction you're entitled to claim. Missing deadlines is another mistake with immediate financial consequences. Whether it's quarterly estimated taxes, annual filings, sales, tax remittances, or payroll reporting, the penalties for lateness are steep. I've seen cases where a business owed $2,000 in taxes but ended up paying over $600 once penalties and interest were added, and these are entirely preventable. In fact, one of the most cost-effective steps a business can take is to set up a digital compliance calendar. There are free tools and paid services that send reminders, track due dates, and even handle certain submissions automatically. And in 2025, many cloud-based payroll systems file tax reports for you as long as your data is entered on time. The point is, there's no reason to lose money to penalties when technology makes deadline management so easy. Closely related to this is the mistake of overlooking small deductions. It's easy to remember big-ticket items like rent, utilities, and large equipment, but the smaller, recurring expenses add up in ways that surprise many owners. Things like mileage for business travel, part of your phone and internet bill if used for work, subscriptions to industry publications, professional association fees, continuing education courses, even coffee for client meetings, they all count. A 2024 survey by the National Small Business Association found that 31% of owners didn't claim deductions they were eligible for simply because they didn't realize they qualified. That's lost money. The solution is awareness and tracking. If it's legitimately connected to running your business, document it. By the end of the year, these small amounts often total thousands of dollars in tax savings. Finally, one of the most expensive mistakes is assuming you can handle everything yourself without professional help. I understand the impulse. You're trying to control costs, but a skilled accountant or tax advisor often pays for themselves many times over. They can identify deductions you didn't know existed, keep you compliant with changing laws, and offer strategic advice to improve profitability. I've seen a retail store owner who resisted hiring an accountant for years, thinking it was an unnecessary expense. When she finally did, the accountant uncovered over $18.00 in missed deductions from prior years and helped her restructure her payment schedule to improve cash flow. In the first year alone, the net benefit far outweighed the accountant's fees. In 2025, with the complexity of new reporting requirements, professional guidance isn't a luxury. It's a necessity for any business serious about long-term success. What I want you to take away from all this is that accounting mistakes rarely look dangerous in the moment. They seem small, even trivial, but over time, they drain profit, increase risk, and reduce your ability to reinvest in your business. The beauty of these mistakes, though, is that every single one is fixable. You don't need to overhaul your entire financial system overnight. Start with one improvement. Open that separate account. Schedule a weekly bookkeeping session. Set up receipt scanning. The progress builds from there. In 2025, small businesses face enough challenges from outside forces. Don't let internal errors add to the pressure. Every dollar you save through better accounting practices is a dollar you can put toward growth, innovation, and stability. And as you make these changes, you'll notice something else. You'll feel more in control, more confident in your decisions, and better prepared for the future. That's not just good accounting, that's good business.